Joining us now is Robert Linton. He's a senior portfolio manager with Strattners Hedge Fund. Robert, always good to see you.
Good to see you, Don.
We've been talking about, in a previous segment on the program, funding small companies, the challenges that they're facing. You operate internationally. I want to get your perspective on what's going on these days.
Yeah, really what it comes down to for funding these smaller companies is they have to have liquidity in them because investors like funds like us or any of the funds, if there's not liquidity within the stock, then they can't invest. If you put together a certain financing package, like in the form of, say, an equity line of credit or whatever it is, they if they don't have enough volume, it won't support it. So you can make a contract for $100 million, but if there's no liquidity, per the contract, you won't be able to draw down on it. So you got to have a solid company, you got to have liquidity, and some companies it can naturally be derived because maybe their business is in the retail space. They can be seen. My son's always showing me TikToks of companies that are taking off, and they aren't even necessarily public, but people will say, "Oh wow, look at this new hot chicken place," or whatever, and they'll go look it up and see it's public and buy into it. But a lot of these other smaller companies, they just may be development stage, and people haven't even heard of them. So it's like, for shows like this, that's why they're so valuable, to get the word out there for the company, that investors can hear about them. And that's with a public company, it's not just having a business. The other part of your business is making your shareholders happy, and that involves liquidity. So it's important that they keep their eye on both of those facets to get the type of financing they want. Another avenue is, let's say they get a convertible debt, which is great, but they need to make sure they're using that money to really make the company grow, and also creating an investor base for their business, because at some point in time they have to pay back that loan, or they're going to go convert into the market, and those people that are converting into the market are going to want to get their money back. So if there's not enough liquidity, it will end up pushing the price down. So it's very important for the CEOs to focus on maintaining a liquidity. Also, if you're going to be a small cap company on the OTC and you want to graduate to the NASDAQ, you're going to have certain liquidity considerations to be eligible. And even on the NASDAQ, I mean, we deal with a lot of small cap NASDAQ companies, and even they sometimes don't have the liquidity that's necessary to get the type of funding they're looking for. If they're raising $200 million, you need to have a great story. People buy a stock because they want to know that it's going to increase. They look at that both in fundamentals as well as speculation. Is this an innovative product that I can really see being something that gets a good foothold on the market in the near future? So that's pretty much what I'm seeing right now.
Well, Robert, you're a former public company CEO. How do you achieve that balance? Because it's a very delicate balance.
Yeah, well, it's you can't do everything yourself. So it's more about managing the people you're working with people that you can trust, that you have a good open relationship with, that give you honest feedback, give you a clear path of how you can achieve those goals that makes sense to you. Because at the end of the day, as a CEO, you're dealing with a lot of professionals that you're directly managing, and then those people are managing people under them. So you have to make sure that you have the right people all working together, because as a cliche goes, the chain is only as strong as its weakest link.
That's very true. Now, the previous guest we were speaking to said a lot of investors are standing on the sidelines right now. Are you getting that same impression?
Yes, and yeah, I'll tell you what we've been focusing on are more of these unknown companies that we see have a lot of potential. They have a lot of great fundamentals. They have a unique product or a service that maybe the world hasn't seen yet. Because if they are fundamentally undervalued, or they have a higher perceived enterprise value than what they do, they have a much better chance of going up. So we feel more confident in investing in them, because typically our funding deals, it may be at a 4% discount, which isn't very much. So if their stock price is going down, we potentially lose money. So that's not a situation we want to get into. So we really want to evaluate a company closely to make sure that we truly believe in their vision. So, our brand is our company and the companies that we're working with. So if they're successful, we're not only successful today, but successful going into the future.
Are there any particular industries that you're looking harder at right now?
I don't say specifically an industry. I mean, I like things that have to do with tech, just because they have a lot of upside. I mean, there's development costs, but once they really take off, they don't necessarily have as much overhead. But at the same time, I like food companies as well. There's some burger places and gourmet burgers and chicken places that are taking interest to me, just because they really catch on and everybody has to eat. And people it's amazing to me, like this new hot chicken thing, how exciting that is. And it's the most simple thing in the world. I grew up in Louisiana, and I remember when Popeyes first came about, and it was like, wow, this is the best chicken and biscuits ever. What a great thing. And then it took like 20 years before it spread around. I grew up with Krispy Kreme donuts. For my baseball team, I was selling them delivered to people's door for $2 a dozen. Our team kept $1 and Krispy Kreme got $1. Now you buy a dozen donuts, I think it's $14 a dozen. So, and they're all over America. So, there's companies out there like that we look for, especially when we're looking to do some type of a reverse merger into a SPAC. But it just depends. Anything can excite me, but what I look for is what I see as undervalued, where I really see the potential in it and I can get it. And sometimes I like deals that are hard to get, because in those cases, it's difficult for them to convey to the investor what their company is about. So if I look at a company, I'm like, I'm really not getting this by looking at it. And then when I look into it further, I'm like, oh, now I'm getting it. It's just they have yet to figure out the way to get that message to the investor effectively. And if it is done properly, then the growth potential is enormous. So, it's harder for me to do something with Tesla, because everybody knows who they are and they're successful. So the more unknown company is a little more exciting to me, if I like it.
Strattners Hedge Fund, Robert Linton, always a pleasure. Thanks for joining us.
Thank you so much, Don.